Evening. My name is Michael Randolph, and I'm with the National Institute for Strategic and Tactical Planning. I'm also the CEO for the Center for Nonprofit and Community Development. We provide an array of different professional workshops. Today, our workshop is going to focus on putting together a professional business plan. What are the components to actually putting together a business plan? So, what are your learning objectives from the class? First, you should be able to explain the different components of a business plan. Why a business plan is important. What are the mission and vision statement? You should be able to define your market. You should be able to describe your product and your services, your organization and management structure, your marketing and sales strategy, as well as you should have an understanding of your financial business statements. So why is it important to have a plan? Well, plans give you the blueprint to follow. It communicates the tools for your investors, suppliers, employees, and others that are interested in your business. If you don't plan for success, your business will more likely fail. What the business plan should tell others? Well, who you are, why are you in business, what you do and how you do it, where you operate, how will you generate profits, who are your customers, and why is your business important? We start off with the table of contents. This is where you put together your table of contents. Your table of contents is going to list any sections of the business plan. It's going to list key sections of the business plan, and it's used to give the reader a hand up in locating specific section, and it brings the organization and structure. It brings organization and structure to the plan. Executive summary. One of the most important sections of the plan, although it's written last. It provides an enthusiastic snapshot of your business, explaining who you are, what you do, and why. The business. The first thing you want to take in consideration when you start your business is to identify the name of your business. In order to protect that business name, you want to file what's known as a fictitious name registration with your state. In this case, the state of Florida will be Department of the Division of Corporation. In most states, it's called a division of corporation. This protects your legal name. So you want to do what's known as a fictitious name. And a fictitious name, any name other than your legal name. So now let's talk about the different types of business entity. The first is called the sole proprietorship. This is normally the simplest form of business entity. And you are the business as a sole proprietor. Now, one of the good things about a sole proprietor is that you don't have to file those forms and that normally a corporation and other type of businesses have to do, like articles of incorporations or articles of organization. However, most states require that you file that you require that you put together your sales tax license or any permits that are required to run your business. A partnership. The second type of business is known as a partnership. A partnership exists when two or more persons own, when two or more persons co-own a business and share in the profits and losses of their business. Each of the co-owners or partners contribute something to the business. Usually it's money or real estate. Now you do have to file with the jurisdiction that you're in, the state, the city, the county, or whatever jurisdiction you're in. You have to file what's known as a partnership certificate. Now, the next type is called a limited liability company. Now, as it relates to the sole proprietor and the partnership, one of the disadvantages of those two entities is that if someone sue you, they can actually sue you for your personal belongings. They can take your house. Now, they can take anything that you're personal, that you have personal because of the legal status. Now, in order to avoid that, this next type of business setup is called a limited liability company. A limited liability company is a business structure in the United States that combines the benefit of a corporation with those of a partnership or a sole proprietor. Limited liability means owners or members, as is the case when you own an LLC. You're protected from personal assets and generally are not at risk if the LLC faces legal issues or bankruptcy. So you're protected, you're shield. So when someone come after you, they can only come after assets of the company itself, but not you as an individual. Another type of limited liability corporation, a company, is called an L3C. An L3C is a combination of a nonprofit and a for-profit. It's called a low-profit limited liability company. However, currently they're only isolated to about 10 or maybe 12 states. So the uniqueness about this type of entity is the funding sources that you can go after, just like a for-profit business. But you have to be, if this organization type has to be focused on charitable and educational purposes. And it has to have a significant, and it cannot have a significant purpose for the production of income or appreciation of property. And 30, this type of business cannot engage in anything related to politics or the legislative purposes. The funding source of a L3C is unique. One of the funding sources is coming from banks and corporations by way of what's called a program-related investment loan. Unlike unlike a normal for-profit organization, an L3C gets the special privilege of being able to get from banks what's known as a program-related investment. What's unique about this is that most all of these loans are either interest-free or below market loan rate. Normally, when you're an organization and you go to take out a loan and you're for profit, you're going to see a substantial interest. Or unless you are one of your Fortune 500, they get the best deal when it comes to um, having the best interest rates. Well, as an L3C, you get that same privilege. The other thing is that you participate in a sharing or selling of interest in a loan. Loans are guaranteed. It brings about a equity investment that you can make. And also in terms of leases, you can get buildings, lease out to banks and things of that nature. Corporation. Well, what is a corporation? A corporation is an independent legal entity that exists separately from the people who own or operate or manage it. Corporation, limited personal liability. We talked about earlier the LLC type of model. The limited liability feature of a corporation can be valuable in protecting it from personal liability, be it debts or injuries of a person that was hurt because maybe they was hurt related to your company. Someone hit them with a car. Someone came in your business established. They fell down and hurt themselves. Those type of injuries suffer. You're protected from personal liability. The S corporation. If you elect to do an S corporation, it lets you have the limited liability of a corporate shareholder but pay income tax on the same basis as a sole proprietor or partner. Among the other things, this means that as long as you actually participate in the business of an S corporation, business loans can be used to offset against other income reducing. It can be offset against your other income reducing, maybe eliminating your tax burden altogether. A When we talk about limited personal liability, again, we're talking about protecting your organization. We talked about the S corporation, the C corporation. The C corporation under federal income tax law is a unique entity from its shareholder. It means that the corporation has to pay taxes on any income that's left after business expenses have been paid. So you can actually tax two ways, and they call it the double taxation scenario. As a C corporation, you can be taxed in terms of the corporation, and then the individual shareholders also can be taxed. Like, businesses, in order to operate, have to have certain permits and licenses to operate. The I might have this word misspelled, forgive me. The types of licenses and permits that you're going to need is a zoning permit, a business tax receipt, state and professional business licenses, beverages licenses, health permits, and license retail permits, establishment licenses, and environmental regulation licenses as well. Location, location, location. Location is key to the survival of your business. When looking for a location in the area, you should consider what is the zoning for your type of business. Affordability. Can you afford the rent in that particular location? Conditions. Is the site ready to be occupied, or do you have to do some renovations yourself, or the owner has to do it? Competition. What are the surrounding businesses that you're competing with? Supplies. Can people get to your business to deliver your supplies without a hard time? Your potential employees, can they get to you? Safety, what's the crime like? And image, is the location consistent with an image you might want to uh, project? Definition of the market. In defining the market, you should describe the market industry and the outlook on that market. We'll talk about that a little bit later on, as well as the remaining items here. You should define the specific customer needs that your business will satisfy. You should identify your target customers and you should develop a customer profile. The target market. And looking at the target market, we're looking at three key tools that we can use to identify who that market is. The first is demographics. By demographics, we mean age, location, gender, family status, occupation, income level, educational level, etc. of that particular potential customer. The next type is called psychographics. Psychographics are the psychological and cognitive attributes of a customer that reveal their beliefs, their values, and their goals. And then finally, behavioral targeting is a marketing method that uses web users' information to strengthen advertising campaigns. This techniques involve gathering data from a variety of sources about the potential customers' online browsing and shopping behavior. Marketing and sales strategy. Market research. There are two kinds of research. The first is called primary research, and the second is called secondary. Primary research is information you gather yourself. This could include going online or driving around the town to identify your competitors. It also includes interviewing and surveying people who fit the profile of your target customers. It also includes looking at traffic counts at the retail location you are considering. It's a lot of traffic in that particular area. The second type of research is called secondary research. Secondary research or market research is information from sources such as trade organizations, journals, magazines, newspapers, census data, and demographic profile. You can find the information online, at libraries, from Chamber of Commerce, from vendors who sell to your industry, or from government agencies. Market research. In this section of your plan, you should explain the total size of your industry. You should talk about industry trends. Is it growing or is it shrinking? You should be able to talk about the total size of your target market and what is realistic for you to attain. Then finally, you should talk about trends in the target market. Is it growing? How are customers' needs or preference being changing? Description of product and services. Well, this is an important section because in this section you need to talk about your company's product and or services that you plan to sell. You should be able to talk about the program, the problems the product you have or service solves. You should be able to talk about any proprietary features that give you a competitive advantage in the market. And finally, you should be able to talk about how you will price your product and your service. Organization and management. Here, you should be able to talk about a description of how your company is organized. What's the legal form of ownership? Partnership, corporation. You should be able to explain how things are done in your organization. You'll also be talking here in this section about all licenses and permits that you have. And you should do a bio description of all key company managers, key competitors. Some people think that they don't have no competitors, but everybody have a competitor, and you make a mistake if you don't know this. You should, your plan must show that you identify and understand how you differentiate your business from other businesses. This section should include a list of key companies that compete with you. Do they compete across the board? Also, you should include indirect competitors. For instance, if you're opening a restaurant that relies on consumers' discretionary spending, then bars and nightclubs are your indirect competitors. Your niche and your profile. Your positioning in your niche. So now that you gather all this data, you should now be able to have a clear understanding of your business niche, your unique segment of the market, as well as your positioning. How you want to present your company to customers. You should explain each of these following in a short paragraph. How you will market your product and your service. In this section, you should explain the marketing and advertising techniques you plan to use. Your advertisements should include online, print, radio, cable television, out of home, business website, social media. Social media is becoming the key to business. E-commerce is becoming the key to business. That's why you need to have an understanding of not only social media marketing, but also artificial intelligence. Then you should look at your email marketing strategy, your mobile marketing strategy, your content marketing, and your printed materials like brochures and flyers, as well as your public relationship. Ha! Financial management. A lot of people don't want to deal with this, but it's critical that you have a basic understanding of financial statement. The three types of financial statements include a balance sheet, income statement, and cash flow statement. So, a balance sheet. A balance sheet consists of assets minus liabilities equal your net wealth. Your net wealth is what lenders and investors look for when they're thinking about giving you the money that you need. Assets mean everything that you own. The chairs, the tables, your computers, any cars or vans that you might have, any bills, everything that you own is included in terms of your net assets. Your net assets tells about your net worth. It measures your business value. That's what a balance sheet does. And it gives a snapshot in time of where you are. An income statement. An income statement is revenue minus expenses. In other words, your profit and your losses. It measures how a business has performed over a specific period of time. And finally, your cash flow statement. These are monthly statements of cash on hand, including cash and expenses. It's used to determine projected working capital availability and any shortages that you might run into. Startup expenses is key. You need to map this out on your startup expenses as well as your opening day balance sheets. Also included in that is your personal financial statement. So financial plan, let's talk about the different types of plan. Your profit and loss statement, we talked about that earlier, can be as little as 12 months or it can be as much as projected 3 to 5 years. Your cash flow projection can be a year or 3 years. And then you have your projected balance sheet. Another component is your break-even calculation and use of capital. Operational plan. This session explains the daily operation of your business, including its location, equipment, personnel, and it includes production. How will you produce your product or deliver your service? Your service. Describe your production methods, the equipment you use, and how much it will cost to produce what you sell. That's important. How much does it cost to produce what you're selling? Then, secondly, your quality control. How will you maintain consistency? Describe the quality control procedures you use. And then, location. Where is your business going to be located? What type of location is going to be? What type of business? What's the zoning issue? Etc. As well as what is the utilities that you have to pay. The other thing you want to look at is your legal environment. What type of legal environment will your business operate in? And we talked about that earlier. You need to make sure you got all of your required licenses and permit. Any trademarks, copyrights, or patents, you need to make sure you got that in shape. Your insurance cover for your business. Any environmental issues, health, or workplace safety should also be included. And then your personnel. What type of personnel will your business need? Explain in detail what types of employees, what licenses are they going to have, what's going to be their pay structure, what does it take, what are you going to consider to qualify as your employees, and what type of training, if any, you're going to provide for your employees. Your inventory. If your business requires inventory, you should be able to talk about what type of inventory will you have on hand. What will be the average value of the inventory that you have on hand? What's the rate of inventory turnover that you expect? What is your lead time for ordering inventory? And then next is your suppliers. You should list your key suppliers, their name, their address, and other pertinent information. And your tax policy. Is your tax policy, a credit policy, is it a policy that includes cash only? Or is it one that allows a person to pay 30, 60, and 90 days? Your appendix. This is where you talk about your company brochure, resumes, list of business equipment, copy of press articles and advertisement, pictures of your business location and product, information and data supporting the growth of your business, and your key business agreements, such as lease and contract. In conclusion, 9 out of 10 businesses fail in the first year of operation.